So, Steve, you're a big basketball guy. NBA Finals just happened, right? And there's a big saying in sports, defense wins championships. You've heard it before?
Yeah.
And the reason why I bring that up today is because we're in this historic stock market bull run. And when something like that is happening, everyone feels like you see it all over social media. Hey, I'm a genius stock picker.
Mhm.
Are they? Or do they just happen to be in the right place at the right time?
Right.
And it makes me think of this classic story from Mark Cuban, right? And Mark Cuban is also a alumnus of what place?
Indiana University, like myself.
Which just happens to be where you went to school.
Right.
So that right, there's that shared experience. But most people don't realize before he was the owner of the Dallas Mavericks, before, he has jumped into the stuff that, he's trying to disrupt in the medical industry,
Mhm.
he was focused on broadcast.com. And can you tell me, what did broadcast.com do?
Well, they enabled people to broadcast TV live streaming, basically. And the reason he did that, because he was an IU fan. He actually, out of school, got a job in Dallas, Texas, and couldn't watch IU basketball on regular TV. So he invented a way to stream basketball games from anywhere. And so he could watch his IU basketball while in Dallas. And then once he created the technology, then he developed it and sold it.
Right. And what's so fascinating when you think about that is live sports today is ubiquitous when it comes to streaming, right? Even Netflix is doing it.
Mhm.
And it all comes back to really the trail that was blazed by broadcast.com, which all came from someone who just wanted to watch more basketball games.
Right.
I love it. But the other interesting part of the broadcast.com story is they eventually sold that company to Yahoo. And Yahoo didn't pay for the company in stock, or sorry, in cash. They paid for it in stock.
Mhm.
And so that put an interesting dilemma for Mark, right? He looked at that and he's in this position where he has a position that's worth a little over $1 billion, but he can't sell it. They're in the same type of stock market boom that we're in right now.
Mhm.
So what did he do? He focused on a way to protect that.
Right.
And that's where the story gets really interesting. And so, using what's called a protective collar, stock options, he was able to, instead of being stuck in a position where the stock, when it crashed, he lost all that paper money, he actually made more than he started with.
Mhm.
It's considered to be one of the greatest trades in stock market history. And when you think about it from that perspective, when we go through this massive bull run, is any of it real if we haven't locked it in? What would you say to that?
I mean, yes, it is real, but yes, until you've locked it in and or have it protected in some way, it is kind of paper money. I mean, it looks great on paper. And I'll share an example from early in my career, actually about the same time that he sold Yahoo, or sold broadcast.com to Yahoo. There was a person that came to me. They were not yet clients of mine, but they said, "Hey, Steve, we heard you're really good with, investing. Can you help us?" All right, what happened? Well, they were both about 64. They were 6 months from retiring, and they'd accumulated over $1 million, which at the time was their goal to retire. I think they had about 1.2 million. And it was in the stock market. The market had been up through the 90s. I mean, from 96 to 2000 or so was at that point the greatest bull run in history. And they were in really good shape until about 6 months before they came to me. They lost over half of it. Dot-com bubble burst. Again, they didn't cash in. They didn't lock those gains in. They didn't defend themselves, use your terminology. They didn't use defense. And they lost more than half their money in 6 months. And so it drastically changed how they went about trying to approach the future. Like, hey, Steve, can you help us win this back? I'm like, no, it's not. That's not how the stock market works. And so they were in a difficult position. And that was one of the things that prompted me to try and look other places. Like, how do you diversify better, to protect yourself, to play defense, because the stock market does not always go up.
Well, right. And it is wild to think about that. Talk about a nerve-wracking situation. Your company's just been acquired, just to wrap up the Cuban thought. Your company's been acquired. On paper, you're a billionaire and you have no idea if this is going to last.
Right.
And to be in that position, unlike your clients, where, that stock drops 90%, he could have been, still wealthy, But think about the change of that trajectory. He never would have owned the Mavericks, none of those things. But instead, he was able to protect all that, which really goes back to a big
Go,
message that we
go
want to.
back and say
Yeah, go ahead.
something again. It dropped how much?
Yeah, that stock dropped.
90%. Yeah.
Right,
So I just wanted to make sure that got repeated and clarified. So yeah, he could have lost 90% of that
right,
money had he not played defense. So
right.
anyway, go ahead.
Would he have ever become a billionaire? Maybe. But it's certainly a lot harder to be a billionaire when you've lost 90% of that money that you had. And the big takeaway to me from that is potentially the smartest investor is not the one who has the highest gains. It's
Mhm.
the one that has figured out how to protect those gains and transfer them into a new medium to continue to build.
Yeah. And there's different ways you do that. I mean, again, yeah, he was pretty smart. He used options and collars and different strategies like that to protect himself, which is smart. There's other things that you can do besides that to, different strategies. It doesn't have to be quite as complicated as what he did. But yes, protecting yourself is important. And think about this. Over the last 100 years, the stock market has averaged a correction every 3.5 years. Is it automatically guaranteed like clockwork? No, but rarely does it go more than 4 or 5 years, and sometimes it could happen as quick as 2 or 3 years. And so 3.5 years is the average. It's pretty common. You're going to look at a correction every, call it 3.5, 4 years. Well, when did the current bull run start? 2022. There was a correction in 2022, dropped 20, 30%, and then the bull market took off again. So we're 4 years into what is typically a 3.5 to 4 year cycle. And so when you look at it from that standpoint, and that's what people forget. People have short-term memories. They talk about you should play defense. It's like, well, why bother playing defense? The market's going up. It's going up now, but look back 4 years. It doesn't always go up. And I'm not saying to try and time the market, but you don't have lock in the gains. Find ways to protect that downside because a correction is coming. It always does. And again, I'm not trying to predict the future. I'm just looking at the past where it's happened 30 times in a row. So there will be a correction. So how are you protecting yourself?
Well, to your point, it goes back to that concept. I believe the classic analogy is the leaf blower, right? Yeah. If you picked a AI stock this year and made 30% or more, are you a brilliant stock picker? Or do you just happen to be standing in front of a leaf blower, right? Getting propelled forward.
Right.
And it's, the message here is not about, doom and gloom. But the thing to think about it in terms of that parallel is many people were convinced that the internet was going to change the world. And it has. But using another sports analogy, there was a Super Bowl a few years back where I believe it might have been GoDaddy, went through the graveyard of all of the .com companies during the .com boom,
Mm-hmm.
looked like they were going to be the next big thing,
Mm-hmm.
and they were until they weren't.
Right.
And I imagine that, similarly, the nature of economics, we're going to see the same thing with AI. There's going
Right.
to be some big winners, but there are going to be some big losers too.
Right.
And so it's all about, riding that wave, right? Or as they say, as the water is rising, being on the boat long enough, but eventually that water comes back down with it. And so, if you think about some of your lessons from history, you were a financial advisor, you lived this.
Mm-hmm.
But ultimately, you realized, hey, this isn't the best way for diversification to sit here forever.
Right. Well, and again, first of all, I'll go back to your analogy was a rising tide lifts all ships. I mean, when the stock market
Right.
goes up, most things go up together. The problem is confidence grows much faster than wisdom when the market is doing the heavy lifting. Again, like you said, it goes up. Everyone's confident. Everyone, hey, I'm an amazing stock picker. No, they're all going up. And so then how do you offset that? Again, that's where the planning comes in. The defense, locking in some of those gains from time to time. That's where you start getting into portfolio rebalancing. Like, hey, this is up, eightfold. This is amazing. Let's take some of those gains and lock those in and move them somewhere else a little safer. That's where you get into the diversification. Again, when you know, because it's happened, every single time that there's going to be a correction. Okay, yeah, am I going to give up a little of the upside? Perhaps, but maybe at this point you're probably better protecting your downside. That's where if you look at what happens historically, where people get greedy. I tell people the two emotions that will make you poor are greed and fear. And when you look at what happens with the stock market, at this point in time, when you look at the cycle of the stock market, we are at the top. And that's where people are greedy. My gosh, this is going up, this is skyrocketing, this is going up, and they're going all in because it only goes up. Well, because they get greedy. And then they end up buying at the top. They don't want to miss out on the gains. So they're getting in at the top, and then it goes down. Well, gosh, it's only down 10%. It's going to come back. It's down 20%. It's down, and then what happens is the fear of loss kicks in at the bottom. It's like, my gosh, this is down 25%. I'd better get out now before it's too late. And so they get that 25% loss. Then they get out, and maybe it goes down to 30%, then it turns around and they miss the upside again. And if you look at historically, that is what emotionally happens with investors. They get in at the wrong time, they get out at the wrong time. And so that's why timing the market is a terrible idea. And so what I tell people is, one of two things. If you're a long-term investor, just ride it out. Just don't even think about it. That's what my wife does. She's a pharmacist. Money goes into her 401k every month. She doesn't even really know what it's worth. Actually, she knows it goes up. It's been up because she's put in money over the years. She doesn't follow anything. It's not a bad strategy. Long-term investing, money she's not going to touch for a couple of decades, just leave it. But if that's one strategy, because over time, it does go up more than it goes down. But if you are looking to put money into something, if you're looking to play defense and protect something, you look at the cycles and go, okay, I may not be at the very peak, but man, it's really high. Now's the time to protect myself.
Right. There's that classic quote, the bull markets reward confidence, right? It's easy when there's so much momentum everywhere, it's easy to pull the trigger.
Yeah.
Simultaneously, bear markets reveal character, right? Those can be very painful. And, we've talked about in recent weeks some of the secrets of billionaires, where, hey, you can invest in anything in the world. And frankly, we haven't necessarily been talking about what their stock investments are looking
Right.
like. And part of that is because even the people who have made a lot of money, when their company hit it big on the stock market, the reality is they don't just stay invested solely in the stock market.
Right.
So if we talked about Bill Gates buying all the farmland, you can look at Cuban. Cuban went in a variety of different directions away from that. And I think there's an important message within that, which is that diversification, protecting your assets by moving it into other places to build income,
Right.
is really the smart play. Is there anything else that you would kind of say on, thinking through that history with the fact that people ultimately diversify out of some of their stock holdings?
Yeah, well, several things. I'll share a phrase that I use quite often. Actually, I'll use back-to-back Warren Buffett examples. Wealth is created with concentration. Wealth is protected with diversification. So going back to Mark Cuban, what did he do? He concentrated on creating and building a tech company, and that's what created his wealth. But then he took that money and diversified, protected it, etc. And so, whatever you're doing for a living, I mean, if you're a doctor, that's your concentration. That's how you're creating your wealth. But then you diversify, you grow it, you protect it. So that's one thing I'd say. Another one is nobody has created their wealth just in the stock market. Okay, they create wealth in real estate. We talked about that a week or so ago. Or they create wealth by owning a business. And we talked about that a couple weeks ago. Those are the two wealth creators that's been consistent for hundreds of years. The landlords, the merchants, that's how you create wealth. And I'll go back to Warren Buffett because that's the one people, Warren Buffett made his money in the stock market, sort of. The difference is he would buy controlling interests in companies and impact the management because he was a brilliant man who would then go in and change management. He would make the company more profitable. And that is how he would create his wealth. And he was one of those that once he acquired something, he'd hold it for decades. He through the ups and the downs, but the difference is he actually took control and made improvements to the company. That's very different than, if I buy shares of SpaceX, they're not going to ask me how to make the company more profitable. I've got no control. I'm just along for the ride. Whether that ride is up or that ride is down, I'm just along for the ride. And that is not how you create wealth. Again, a lot of people will ask me, oh gosh, you not like the stock market? I do. It serves a purpose. But again, it's just not how you create wealth. It's a great way to diversify. Because again, if all I had was real estate or and businesses, those are creating wealth. Those are great, but I still want other things. I still want to invest in, other businesses, stocks, different things like that. So it is a part of a bigger portfolio. It shouldn't be the only part of your portfolio.
Well, it kind of goes back to, it's that distinction between creating wealth versus growing wealth. Because a lot of people would talk about how the stock market is really designed to grow wealth based off of, starting and contributing and, that exponential growth over time through compounding. But, one of the things that kind of stuck with me that with what you just said there, it might seem somewhat dangerous to bring up Charles Ponzi. And sometimes when you think about certain stocks, they might very well feel very Ponzi-esque or Ponzi adjacent.
Mhm.
But one of the things that's fascinating about his actual story is that multiple times, and there's actually various podcasts that go through his entire life story that are fascinating to listen to. But the whole point that I'm getting at is even this person who was built on a lie, he realized that he needed to diversify. And so multiple times he tried to go legit. He owned a bank at one point. He tried to get real estate. He literally tried to diversify in hopes that would actually allow him to produce enough income so that he could fix his prior mistakes.
Interesting.
And so it's a real fascinating thing to think about. But, the other way to really look at this is just to drive that point home, the big owners of businesses that have made a lot of money in the stock market. It is because their business has become more successful that they were able to get rewarded for those results. That's entirely different. That's them creating wealth
That's right.
versus the growing wealth that you're talking about, right?
That's correct.
Okay. And so, if we think about that all together, ultimately things look great on paper, but until you lock it in, that's really all it is. And another way to look at it is the more things go up and just sit there, the larger of a liability that you have. Would you agree with that?
I don't know that liability is the right word. Liability is what you owe. And so if you think about, a piece of real estate, you own the real estate and it's worth 200,000, but if you have a mortgage at 150, your liability is 150. You do owe that. With the stock market, and a stock, I would say there's risk. And again, it's gone up and there's the definite risk that it will go back down at some point because again, it's cyclical. And so I don't know if I'd call that a liability, but but it is a risk that you have that you're going to lose some of those gains because they're just not locked in.
Yeah, it's kind of like many words have multiple definitions that you can
Yeah.
work with. But when we're talking about liability here, to your point, it goes back to, paper money versus realized, gains.
Right.
And that's the big difference. Yeah, I think almost everyone has had that position where, maybe they got a little greedy and all of a sudden they had 20% less than they had the day before,
Yeah.
particularly if you're focused on something other than an index where you're just part of, a company, a speculative position. And if you think about, I mean, that's the wild thing. The largest companies, in the world have those moments where they can absolutely go down 20%
Hmm.
or they can stay stagnant. And, I kind of want to hear your thoughts on really one of the most famous companies in the news that just IPO'd. I think people would be interested. But before we get to that, I'd bring up this point and then you can kind of share your thoughts on SpaceX.
Hmm.
But before SpaceX, right, we have Microsoft. And Microsoft in recent history has been on this massive tear. In 2026, a bit of a pullback. But before that, if we look at the history of that company, there was a lost decade, more than a decade, where effectively the company stayed stagnant. That company by itself was not this big wealth strategy. It was something where you had to have that conviction, that time in the market, almost 20 years, to
Hmm.
really get a great return on that investment.
Right.
And, once again, I think that's something interesting to look at from a diversification point. So if you want to talk about how that compares to your thoughts on SpaceX and just diversification in general and time in the market, love to hear it.
Sure. Well, it kind of reinforces the point I was making earlier about time in the market. And again, Microsoft, if you look at the gains from now till, from 30 years ago until now, they're huge. But it's not a line that just goes up. It's a line that goes up and down and up and sometimes way down. But over time, it does, a lot of stocks do tend to appreciate as the companies grow and develop. And part of that, it's a whole nother conversation, but part of that gets into inflation, where, just the dollar value of things are going up over time. That helps kind of, drive the market prices up a little bit. But time in the market, just letting the money sit and grow over time, that's sometimes what you need to do with some of these to get some of these gains. Now, as far as SpaceX, it's a little more complicated. My concern is that it is the most hyped IPO in history. And does it, could it be worth a lot? Absolutely. Some of what they've done is amazing. Elon Musk has shown that he is a brilliant businessman. And is it worth what they currently say it's worth? Hard to say. A lot of the projections are based on things that they haven't even launched yet. No pun intended. But things they haven't even created or released yet. And so you start looking at that, okay, well, yeah, but once they do that, should create this revenue and that should create this revenue. That's a lot of projections. And if it all turns out, then the current valuation is accurate. If any of those things don't turn out as planned, then it's overvalued. So it's really hard to say. Do I wish that I had gotten in, a year or two ago before it went public? Yeah, it would have been nice. And as long as there's a way to exit. Would I invest now? No. When it went public, the day it went public, I'm like, there's no way. It is too hyped. Again, it's the greed. It's like I want in, and I think people are overpaying to get in because you see this is going to go up and up. So I don't dislike it. I think it's a very valuable company, but I don't see it. Put it this way: how hard would it be for that company to grow 10x over the next 5 years? Whereas you have find a smaller company that could grow 10x. And I'll share a funny example. I guess it's not that funny because I have a friend who put quite a bit into it. Virgin Atlantic, because they started expanding into space travel as well, but they're down about 95%. Oops. Now, could they change a couple of things and get back on track? Absolutely. Frankly, they have a better chance of growing 10x than SpaceX does. If they recovered, half of where they were, that's a 10x growth. So those are kind of some of my thoughts on that. And another thought I had was kind of comical. Thinking back 20 years ago, who did you get your internet services from? Everybody has Gmail now, right? I shouldn't say everybody.
Right.
Most people have Gmail. Well, 20 years ago, it was AOL. And I saw something just recently where AOL and was it AIM, their messaging service, and one other company, they're like, the three of them have combined and they're relaunching an IPO. So maybe it'll come back, maybe it won't. But it's just, you look back at, 25 years ago, and AOL is this huge multi-billion-dollar successful company until it wasn't.
Right. Yeah. It's so fascinating to think about that. The hype in terms of how big it could, because sometimes it can.
Yeah.
And sometimes it may not. I think anyone from that era can recognize, the instant messenger chime that came in, right? Or the you got mail message. Fascinating things, to think about in history. But, if we tie this all together,
Yeah.
I'm left with thinking about, the overall requirement to have a lot of discipline versus emotion getting bought up in hype,
Yep.
like tulip mania, right? Emotion getting scared and not having conviction, or making sure that you have enough discipline to realize, hey, maybe this is not a great investment and I didn't do enough due diligence to understand what I had. But I think there's one other key thing that you said there that is really important to understand, and that is timing from the perspective of when you've lined up into an investment. There's a major difference between being in that sort of position where you're chasing something after IPO, after the hype cycle has already happened,
Right.
versus you've been there for a year already and you're the exit, right? That's coming in, right? They're buying your shares and providing you that exit liquidity.
Yeah.
And that makes me think of, you've actually invested in some off market or pre IPO companies, some startups.
Mm-hmm.
And if you look at it from that perspective, I imagine you probably have some stories about what those gains were like before the company really, in the eyes of the public, even got started. Is there
Mm-hmm.
something you would share there?
The most recent one is one that we invested in, last late summer, early fall. I want to say August of 2025. and it hit, it was pre-IPO. We got in early. We happened to know the founders and had some good connections, learned about it, met, again, I've got a comprehensive checklist for every startup that I look at. It must meet this, that, boom, every single one of them. Company was laid out just the way it should have been. And so we got in at $2.30 a share, and it went public last month on NASDAQ at 13 a share. And so, is that 100-fold? No, but it's a 6x return in a year. It's pretty good. And so, but again, it's so you see these opportunities and do your due diligence, and yes, you can profit from that quite nicely. But then if you look at, I guess, just thinking big picture, one of the most important things you have to understand is yourself. You talked about consistency, about discipline was the word you were using. You have to know yourself and what your strategy is. Are you someone who said, hey, I'm a long-term investor. I really don't want to watch the market that much. I don't want to try and time it, that sort of thing. Great. Dollar cost average, put money in every month, put it into indexes, and don't sell and don't worry about it. Again, that's the approach my wife uses, and it works great for her. Or maybe you're someone who doesn't try and time it necessarily, but to your point, you try and get in on a good opportunity, try and get out when it makes sense, and as long as you're getting most of that gain, you lock those gains in and you move on, and you're getting in every few months, out every few years, whatever it is, and okay, that's a different type of investor. Another type is someone who's pretty much day trading. All right, what's up today? What's down today? What should I? I'm going to buy something today, and I might sell it tomorrow morning, or I might sell it in a week. That's a very different type of investor. That takes even more discipline, and it takes a lot of time commitment. And so the first thing to understand is, which of those categories are you in? That's going to drive the type of stock market investing or the type of protection that you should use to protect your gains. And so most of what we talked about here is kind of addressing that middle group that, hey, I get in sometimes, I get out sometimes. Now's not a good time to get in. You may want to get some out to protect yourself.
Well, the other takeaway that I had with what you just said there, right? And effectively, in all those different examples, there is beyond the parallel of the stock market, there is also the parallel of process. To be the most effective at all of those, you also need to have a good process. And when you think about, your own history, right? The luckiest investment you might have ever made in your career, right? Versus the best structured investment, you know, within process, the roughly call it 4 or 5x return that you experienced in 1 year on the stock that you just mentioned, that wasn't because of luck. That was because of structured process, going through due diligence, identifying the opportunity, and then seizing it. And I mean, would you say there's, potentially a lesson there as well?
Absolutely. I'll share that and then we'll wrap this up. But there's 3 parts to it. One is having the right network and connections to see and get that opportunity to begin with, because a lot of people never knew that opportunity even existed. So it's, people within our community did because I shared it with them, but we were able to do that because it was part of a private community. So getting access to those, that's the first part. Second part is that, like you said, the process to do the right due diligence. And I can tell you, I get, because of my network, because of what I do, I would say I'm averaging now an opportunity a day. Every single day, I get another startup. I got 2 of them yesterday. Both look really interesting. I'm doing my due diligence, but I'm not recommending an opportunity every day. Most of them, because of that discipline, because of that due diligence, they get filtered out. Nope, maybe let's take a deeper look, And so there's that process part. Then that third part is capital. So and this is where it becomes important, when there is a correction, a lot of people, they stay in too long and their stocks went down. They went all in at the top. And then when it went down, they lost money and had no opportunity to buy things that were low. Whereas if you maintain liquidity and you use discipline, hopefully you locked in some of those gains at the top, sold it, maybe put it somewhere else where it's a little bit more liquid. And then when it drops 20 or 30 or 40%, a year from now, let's scoop in and get some really good deals. And so if you're going to go in and out of the market, that's the approach that I would use. Would be, again, you got to get access to the deals. You got to perform due diligence, but you have to have capital available when those opportunities present themselves.
Right. It goes back to that, that sense of discipline in terms of really thinking about a portfolio allocation, always keeping some dry powder on the side, some cash on the sideline, so to speak, really helps to position you to seize opportunities that others might miss.
That's right.
And if we kind of just wrapping this up, right? The market can easily make you money by accident, but I think a core message here is that discipline lets you keep it on purpose.
Yeah.
And is there anything else that you would add to that?
No, I like that. That's good wording. So no, I like that.
Okay, great. Well, with that, we'll wrap up for today. Thank you, Steve, as always.
Thanks so much, Dave. Appreciate it. Thanks, everyone.